Hello students, Dr. Wang is here recording, and in this video clip, we are going to start a new chapter, chapter number 2, which is about analyzing and recording accounting transactions. And here is our learning objectives, and first we're gonna explain the steps that we need to take to process all the accounting transactions, and also explore the role of source documents. And then we will describe an account that is used for recording transactions. And we are going to do a number of accounts, not just one. And then we will describe a ledger and a chart of accounts. So basically, a ledger is a combination of all the accounts we covered. And then we will define debit and credits and explain double entry accounting. And double entry accounting is different than single entry accounting because each activity has two sides. And there's a debit side, there's a credit side. There is a minus, there is a plus. And that's a big important invention in modern finance and accounting practices. And then we will move on to some analytical problems. We will analyze the impact of transactions on accounts and the financial statements. And we will compute the debt ratio and describe its use in analyzing financial conditions. All right, so let's first talk about the steps in processing transactions. Right here, we have a system of accounts. So each activity would be recorded as an account. So business transactions and events are starting points of financial statements. So we're going to process from transactions to financial statements. So for each event, it started as one transaction, and then we're going to build up all the transactions to a ledger, and then we build up all the ledger information to financial statements. The very first thing we need to do is to identify each transaction and event from source documents. And the source documents could be a bill being outstanding or a supplies being purchased. Our second step is to analyze each transaction event using the accounting equation. And what's the most important accounting equation? Yes, it's total assets equals to total liabilities plus equity. The third step is to record all the relevant transactions and events in a journal. And then we're going to post the journal information to an overall summarized ledger accounts. And last, we're going to prepare and analyze the trial balance on the financial statements. So these are the source documents. As you can see, if you're running businesses, you're going to be drawn with all these bills and checks and all the records and the statements. So you have checks paid or received, or you have an employee earnings record. You need to know how much you're going to pay to your employees that you just hired. And also you need to pay bills to your supplier, to your landlord. And you also have a purchase orders, and you have a bank statements. And the bank is your creditor, and you just borrow money from a bank. The bank is always on your tail, ask you to pay back principal plus interest. You also have a sales tickets. When you deliver your service or products, you may not get 100% paid in cash. You may have account receivable. You may have a sales ticket. So these are the source documents you're going to be dealing every time when you are running business. And each of the source document will be recorded as a accounting activity. So now let's learn how to record transactions. So first of all, you should know account. What is an account? And that basically defines the entire discipline of accounting. An account is a record of increases and decreases in a specific assets, liability, equity, revenue, or expense. So if any changes related with these items we learned before in the financial statements, then that will be an accounting record. And after we got an accounting record, we will summarize all of them, okay, different, maybe hundreds or even thousands of these accounts into the general ledger book. And the general ledger is a record of all accounts used by the company. So, of course, we're gonna sort all the accounts based on their categories. So we have assets, we have liabilities, and we have equity. And equity could be further divided into owner's equity, owner's withdrawal, revenues, and expenses. If you look at an assets account, let's say this is a company you have, and what are the assets under the company control? The most important assets, of course, is cash. And then you have outstanding bills to collect. This is the money that wait for you to be collected. And this is called account receivable. You also have a notes receivable, which is a short-term investment. You also have a prepaid account. You have supplies, the raw materials you purchased for further production. Of course, you have equipment, building, and land. So these are considered assets of a company. So the harder accounts for you to understand may be accounts receivable, notes receivable, and the prepaid accounts. So don't worry about that. We will spend more time on these separate accounts in later chapters. And the liability accounts could be divided into notes payable, accounts payable, and unearned revenue and accrued liabilities. So these are the money that you will pay in the future. And since you have not paid it yet, that's a liability to you. That's your debt. That's your obligation. And the equity account, as I mentioned earlier, is consist of owner's capital minus owner's withdrawals and plus revenues minus expenses. And after we get all these accounts in the right place, total assets equals to liabilities plus equity, which include owner's capital minus withdrawals plus revenue minus expenses. All right. As you can see that revenue and owner's contribution would increase your equity, and expenses and owner's withdrawal would decrease equity. Likewise, if you build up more equipment, purchase more land, your assets would increase. If you borrow more money from a bank or have more unpaid bills, then your liability would also increase, and vice versa. And now let's describe a ledger and a chart of accounts. So right here, the ledger is composed of many individual factors, individual accounts. So this chart is a list of all accounts, and each account you may notice has its identifying number, okay, or ID number. So for cash, it's 101. Well, you know, cash is the most important one, so definitely we use this number to note its importance. You also have account receivable, supplies. Their numbers all start with 1. For liabilities, the numbers start with 2. And for equity, the numbers start with 3. For revenues, the numbers start with 4. And for expenses, the numbers start with 6. You can spend some time to observe, so what is under the revenue, what is under the expenses. All right, so now here is a practice. Based on what I just told you, please just fill in the blank. So which of the item is assets, which of the item is liabilities, and which is equity. So the prepaid rent, let's say if you are going to pay your rent, let's say $100 each month, but you don't pay it on a by month basis. You don't pay it each month. Instead, you pay a 12 months rent all at once in January. So you don't have to worry about the payment of a rent in February and March all the way to December. So if you have paid that full year rent, it will be called prepaid rent. And that is an asset to you. That is a plus to you because you don't have to worry about your obligation payment in the future. Okay? And for owner's capital, it is definitely a equity. And for notes receivable, you're going to receive it in the future. And for accounts payable, it is going to be paid in the future. That's definitely a liability. So right here, the textbook is telling you, here's very important information for you to remember. You have to memorize this. If anything is marked as a prepaid, just like your prepaid rent, it's always an asset. just like you pay your rent for the next 12 months, so or maybe next 12 years. If you have paid it all, so you have a prepaid rent under your assets. So that's definitely a plus for you. And if you have receivables, so the receivable basically means the money you're gonna receive in the future. That's also a plus for you, right? You're gonna get paid, so you're gonna be happy. And this is also an asset. If any accounts marked with a receivable, this is considered an assets. But for payables, these are always liabilities because you're gonna pay the money in the future. You're gonna spend money in the future, and today that basically is your debt obligation. So that's a liability. And then you have unearned stuff. This is also a liability. For example, somebody just to pay you, okay, they pay you like $100 for 2 years of your services. Well, that's pretty cheap though. The thing is, if you have already been paid, but you have not delivered the service yet for the next 2 years. Right now, it is obligation for you. It's a liability for you. You know that because you have to pay in the future in with your services. So the unearned revenue would be called a liability. So right here is a key. So prepaid rent, notes receivable are assets. The payables, like accounts payable, interest payable, are liabilities, and so are wages payable and rent payables. And for unearned revenue, which is item 8, this is a liability. And equity part, that's pretty easy to figure out. You have owner's equity, and you also have equipment, that's assets. Oh, you also have a prepaid insurance. Let's say if you should pay your insurance on a per month basis, but you just paid 24 months of insurance all at once, then that insurance is your assets. So you don't have to worry about paying later. It's like you save money in the future. All right, our next subject is to define debits and credits and explain double entry accounting. As I said earlier, double entry accounting is a big, innovative accounting practice that changed the entire modern history of businesses. So under the double entry accounting system, we have a debit and we have a credit. And for each activity occur that there is always a debit, a negative record, and a credit, which is a positive record. So we use a T account. You see this T account, you see this is a horizontal line and a vertical line, and that is a letter T. That's called a T account. So on the right hand of the T account, we have a credit, which is a plus, and on the left hand side, we have a debit. Okay, but the thing is, we can't really say everything get an increase should be a plus and everything get a decrease should be a debit. We will analyze it on a case-by-case basis. And the T account represents a ledger account, and it will be used to describe the effects of one or more transactions. Right here, it comes to our most basic accounting equation: assets equals to liabilities plus equity. And if you just to look at assets and equity, let's just ignore liabilities. So we did this practice when an owner put $30,000 cash in equity. So what happens is equity increased by 30,000 and cash as part of assets increased by 30,000. But in the double entry accounting, there's always a credit, there's always a debit. So for the 30,000 increase of equity, this is recorded as a credit of equity, and there has to be a debit on assets. So when your cash increased by 30,000, that is recorded as debit. All right, although cash increased, but as assets is a debit. So from this example, you can see that we're going to record differently for equity and assets. So when equity increase, that's a credit. And when assets increase, that's a debit. We do this just because we want to follow the basic principle of a T account. Whenever there is a credit, there has to be a debit. Likewise, I can give you another example. If you just borrow $20,000 from a bank, and then you use that $20,000 to buy an asset, let's say to buy a car, then your liability side increase. You owe bank 20,000, so you have more liability, and you just purchased a car, so assets also increase. The thing is, under double entry accounting, there is a credit, there is a debit. So for the increase of a loan or liability, there's a credit here being recorded. And for increase of a car or you're possessing, there is a debit here. So we treat differently for assets and liabilities. And likewise, if equity decrease, then that's a credit, and the liability decrease, that's equity and the liabilities goes to the same direction. If there is a decrease, we call it a debit. If there is an increase, we call it a credit. And for assets, if there is an increase of assets, we actually record it as a credit. So that's very important for us to remember. All right, and if we expand equity, we decompose equity into four factors: owner's capital, owner withdrawals, revenues, and expenses. And as I said, if equity increase, then that would be a credit. So what would contribute to the increase of equity? Of course, if there's more owner's capital being injected in the business, that's an increase of equity, that's a credit. If you earn more revenue, then that is a increase of equity, so that's a credit. And if you withdraw money from the equity, then that basically makes your equity decrease, then it will be a debit. And if you spend more money to buy things, if you have more expenses, that's gonna make your equity reduce, and this would be a debit. So when expenses and withdrawal increase, those would be recorded as debits and should have a negative impact on equity. And here we have account balance. So you will see a T account, and that records to several activities. So you have a cash is the title for this T account. And what happened there is the company received investment by owner. So basically that's owner's equity increase on the equity side. But on the asset side, under this cash account, the cash increased by 30,000. And when the company earns revenue, then there's an increase on the equity side. There's also increase in the asset side, which is under a cash account. You see a $4,200 increase in cash. And also, if you collect your account receivable, it's not outstanding anymore. You just collect the money, so you get more cash, $1,900. So these are the positive effect on cash. However, just because cash is an asset, any increase of assets would be recorded as a debit, and it's always debit on the left and a credit on the right. Let's see what is on the right hand side of the T account. Of course, those would be credits. As I said, for assets, the credits would be a decrease. So what would make this assets called cash decrease? When the company spent money to purchase supplies, the company spent $2,500, so that's a cash deduction. That's a credit on this T account. If the company purchased equipment for $26,000, so that also is a credit. Okay, that makes your cash goes down. Just because cash is assets, when it goes down, it is a credit. And any payment, for example, rent, salary, and also even withdrawals by owners, these are cash outflows from a company. And when cash is going down, when assets go down, so that will be recorded as a credit. And when you pay your account payables, of course, when you pay cash, then that's a credit. And if you combine both debits and credits, you will see a balance. Okay, the balance on the debit side, because the number here in total is 36,100. That is greater than the number on this side, 31,300. So the difference to 4,800. So that's how much the debit side gets greater than the credit side by. So this is 4,800.